Hello everyone. Welcome back to Fixed versus Variable Part 2. My name is Preeti and I am both a real estate broker and a mortgage broker for close to 20 years. Last week I spoke about the difference between a fixed rate and a variable rate mortgage. And I got a few calls from existing clients, of course, with some more questions. But I also got calls from clients who were just renewing their existing mortgage. And they were getting a pretty decent rate on the fixed side. So I advised them to stay fixed, which is polar opposite to my previous video. But for those clients, staying fixed made more sense. Today, I'm going to break it down for you in, different scenarios. So hopefully I succeed in making it more clear on what options will work for you and in which scenario. But first, you know the drill. Make sure to like, share and tap that bell icon. And hey, if you're new, welcome to my channel. And you see that little subscription button down there? Be a sweetheart and hit that too, just to get me motivated to keep you up to date with everything real estate. Let's start with a tiny recap of what we discussed last week. I explained the difference between a fixed and a variable, and also why we are seeing the rate hikes and what pushes the government and the banks to increase the interest rates. In a nutshell, what I was trying to say was that the way the fixed rates are today, it is advisable to go variable. Why? Well, because A, the rates will be lower. B, we also qualify for more because of the stress test, and that is still at 5.25. Now, I know with the new changes coming in July, will this 5.25 still stay at that? No, it won't. But I will get to that, I promise. Point number C, you can always break the mortgage for cheap. And once the rate starts to stabilize and fixed goes down, you can always move from the variable to the fixed with no penalties. So let's pick one topic at a time. Let's start with scenarios in which you find yourself debating between the fixed and the variable. Scenario number 1, when you're looking to buy a property. Now, when you're looking to purchase a home, the bank takes into account you, your income, your credit, and the property in question. You may have a great history with the bank, but the application is still deemed as a brand new application, and you are checked out with the fine-tooth comb because the property in question is also a priority. So because of this, the rates that you will get will be the prevailing rates. Now, if you're putting down less than 20%, the rates are set by CMHC and the banks really cannot do much to assist you there. But they always have programs to help you get a cheaper rate. But that being said, the rates and the spread on the variable, which is the prime minus 0.1 or 0.5, that tends to be a little better if you have, as compared to 20% down. Now, I have done an entire video on this topic, and to understand the logic behind this madness, watch the video on the down payment dilemma. But the fact of the matter is that if you are purchasing a property, the rates that you will get will be the current rates that are in the market. So what option do you have? Variable is king. Scenario number 2, when you are refinancing. So basically you have a mortgage and you want to take money out. Now let's say you have a mortgage with a bank and you have tons of equity sitting there. You currently have an amazing rate and you don't want to let that rate go, but you need the money. So one of the options with the bank is to refinance your existing mortgage. The bank in this case, and if you qualify, will give you the two options. Either you break your existing mortgage and pay the penalties, and then get a brand new mortgage with new rates and new terms, etc. Or you can do what they call as a blend and extend, where they will keep your existing mortgage as is with the rates, the term, everything is the same, including the monthly payment. And the balance that you need or the additional funds that you need will be given to you as a new mortgage, and they're going to blend both the rates. But the additional funds will be at the new rate, which means if you are going variable, it's going to be cheaper, and if you're going fixed, it's going to be what the fixed rate is. Now, they also have a second option where they will just put that as a second mortgage just to avoid any confusion. But the problem with that is if you have only 1 year left, then the new mortgage or the additional funds will be for that period of time only, and that sometimes may not work in your favor. So it is imperative that you get all the facts and figures up front from your bank, and always speak to an experienced mortgage broker to see what option works best for you. But again, when it comes to fixed versus variable in a refinance scenario, additional funds, try and go variable. You will save money. Finally, scenario number 3. Renewal of your existing mortgage. This is easy peasy. The banks by law have to send you a renewal document as long as you have not defaulted on your mortgage. And the rates they give you on renewal will first always be the current market rates, unless they're trying to renew and lock you in early. Now, once you get that, all you have to do is look at the options available. Talk to an experienced broker. Find out what the current rates are from other different banks, both on fixed and variable. And sometimes you'll see that that information will help you get a better rate at renewal. It's only in this scenario that there is a 10% chance that the fixed rate will be at par with the variable, especially if the bank is aware of your financial situation being excellent and your credit being good. They will try to keep you with them, and you can use this as leverage to lock your existing mortgage at a much cheaper fixed rate. If not, go variable. Now, in my previous video, I threw a lot of numbers at you guys on how to save money by going variable in comparison to a fixed. But come July, prime will go up from 3.7% to 4.2%. And the rumors are that it might even jump to 4.45%. So then what is going to happen to the variable rate? Like I said, don't just walk into your bank and get the rates. Talk to a mortgage broker. Also, because they have a lot of other AAA options available for you. Yes, the variable rate will jump to maybe 3.5 or 3.7, but it is still better than the fixed, which is sitting at 4.5 and 4.75 right now. And remember, if you're locked into a fixed for 5 years, there's no turning away from it. You are locked in, period. Where if you had a variable rate mortgage and let's say 2 years down the road, rates start dropping, once inflation settles, then you will have the option of locking your mortgage at a reasonable rate. Even then, I would say stay variable. The other scary factor right now that nobody's talking about is the qualifying rate. Currently, we are being qualified at 5.25. So if our variable rate is prime minus 0.5, then our current variable rate today is 3.7 minus 0.5, which is at 3.2. Now, the rule of the stress test is that it's calculated at 5.25 or 2% more than the current interest rate you are getting. So currently, you still fall under the 5.25% mark. So variable is good. But come July, prime is going up. And let's say it jumps by another 0.75%, taking prime to 4.75. And the variable, which is prime minus 0.50, will be at 3.95. The stress test in this case will jump to 5.95. That is what you will have to qualify at. But let's look at the fixed for a minute. It's still at 4.5. So what are they qualifying you with 4.5 plus 2%? Taking your qualification stress test to 6.5. That in itself is a big difference. Now, unless the government and CMHC has mercy on us and make some change, which honestly I don't think they will. Till then, it is what it is. Go variable. The final advantage is in the event that you want to sell your home or refinance your home. When you have a variable rate mortgage, the penalties to break the mortgage is only 3 months interest penalty, which can be anywhere from $3,000 to $4,000. But if you have a fixed rate mortgage and you have a few years left on the contract, then you're looking at a potential $10,000 or as high as $20,000. I've even seen penalties go up to $30,000 because they take the interest payments from the day you paid off till your contract ends, which then stops you from accomplishing what you want to, and you are stuck with the mortgage and there is nothing you can do about it except pay the bank the penalties. That is why me personally, I am a strong advocate for the variable rate. And yes, I've had a debate with senior mortgage brokers in the past where, fixed was in their twos. But today, I'm sure these same brokers will support the variable over the fixed any day. So if you found value and like this video and would like to see more content, click on these boxes on the screen above. Once again, my name is Preeti Rao and my contact information is in the description box below. Make sure to hit like, share, subscribe and the bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens the door to your dream home.